what is the difference between labor-based income tax, so income tax, and capital gains tax? So you probably have a decent idea, if you're a working person, you probably have a decent idea of what labor tax is, right? So you work for a company, you get your paycheck, there's a whole set of line items where you get your Social Security tax taken out, your Medicare tax taken out, your state tax taken out, your municipality tax taken out, right? Those are your typical labor taxes. That's income taxes. That tax is based on the amount of income you make, and there are marginal rates. What's a marginal rate? A marginal rate is the amount of tax you pay on a certain grouping of money. So for an illustrative example, say you make $40,000 a year, and I'm not using the actual tax numbers, I'm just making these numbers up. So if you do want to see what the actual tax code is, it's available online at irs.gov. But let's take an example, right? So say you make $40,000 in a year. So let's say the federal government says that up to $12,000, you pay 0% tax on that. Okay, fair. So that makes sense. So you get to keep the first $12,000 that you make. So then it says on any amount of money you make over $12,000 and under $30,000, you pay 10% of tax on that. Okay, so we've now covered the first $30,000 a year that you've made, and the $18,000 in this middle portion here will be taxed at 10%. So 10% of 18,000 is $1,800. Okay, so that's $1,800 worth of tax you're going to pay. Now let's say that on any amount of money you make over $30,000 and above, they're going to take 15%. Okay, so now you've only made, because you're making $40,000 a year, you've only made $10,000 more than the rate you would have paid up to $30,000. So what happens is that $10,000 is then taxed at that 15% rate. 15% of $10,000 is $1,500. So you add that marginal tax to the marginal tax you paid on your middle 18,000, which was 1,800. So you add 1,800 plus 1,500, and you get $3,300, which will be your total taxes for that amount of money. So that's what marginal tax rate means. It just means the amount of money that you make is divided into sections, and those sections are taxed at different rates. So there's just a general idea of how labor taxes typically work. But anyway, so labor tax is assessed based on the amount of money that you get for working, for going to job, working a job, 8 hours a day, whatever your working situation is, the money that you get from there is taxed. Now that's just if you're an employee, okay? So many people now are no longer working standard employee jobs. They're working gigs or in the gig economy as independent contractors. So independent contractors are assessed a slightly higher rate for their work. And that's taxed differently. So maybe instead of between the 12,000 and 30,000, instead of getting charged 10% in tax, maybe it's 12%. I don't know the numbers. You should look online to find these numbers, but I'm just giving you examples so that you can see pretty much how this works. So this is kind of your regular labor income tax that most workers, regardless of they're working a gig job or a regular employment job, this is something you'll be familiar with because this is the type of work tax relationship that you're used to. Okay, so that's the first type of taxes. And this is by far the most common type of tax collected. Then there is capital gains tax, which is a different type of tax. And this tax works a little bit differently. So instead of being on the amount of money you're paid for selling your labor to an employer, this capital gains is a tax that is levied on the benefit that you make from investments. So this can come in a variety of different ways, and the way that this benefit is assessed changes depending on how you do. So So say you buy a house, okay? And again, there are lots of different rules about this. If you want more information, go to irs.gov. But say you buy a house, and when you buy the house, it's a $100,000 house, okay? So say you live in this house for 20 years, and you do repairs on it, you make it nicer, whatever. So at the end of 20 years, you want to sell the house. And now it's worth $200,000. So you sell the house for $200,000. So in the time that you've owned this house, which by the way is considered an asset, the house has appreciated in value $100,000. So it's considered that you have made $100,000 by this sale. Now there are other things continue like the time value of money, but we're just going with easy examples here. So on this $100,000 that you have made from the selling of your house and its appreciation value, the government wants a tax on that. So there might be, there'll be some percent tax that you pay on that amount of money, and that is the capital gain. So let's say it's 5%, right? So you pay $5,000 on that, and that's your capital gains tax for the appreciation of your house. Okay, so that's for an appreciating asset for a large appreciating asset like a house. Now people do this not just with houses, they do this with hotels, other buildings. Buildings can be bought, sold, and traded much like any other asset, and they appreciate and depreciate in value, and the tax is taken appropriately and accordingly, in theory. But oftentimes, before I get to that, another asset that is frequently taxed with capital gains are your investment rates. And these, like on the house model, don't come into effect until you actually make money from them, right? So if you have a dividend, that dividend can be taxed. It will also be taxed at capital gains rates, but this is passive income, right? So if you have a stock portfolio, many of us do for our 401ks if we have them, because the pension system is essentially dead unless you work for the federal government or a state government. But so your 401k, it pays dividends, right? The company thanks you, in theory, for sticking with them with your stock. They pay you a dividend. You probably put that dividend right back in your account. But whatever, if it's large enough, the federal government wants their cut. So they take some percentage of all that dividend money that's coming to you. Additionally, the federal government takes a cut again when you go to sell the stock. So if you live up your 401k, you don't touch it up until you want to retire, you then decide to take all that money out of the system. That money has appreciated now a significant amount, plus you've added money to it. The government wants a cut of the amount of money that has appreciated from that account, and they take some percentage of it. They take some percentage of it once you sell it. So if you sell it for $400,000 or whatever, that they want some cut of that. So that's how capital gains works. So the reason I'm telling you about capital gains tax versus labor income tax and independent contractor or IC tax work is because there is an interesting phenomenon that occurs in the United States tax code where labor income is taxed at a higher rate than what's called passive income or capital gains rates. And there's a bunch of different ways that capital gains rates are taxed, but for now, it just makes more sense to talk about them as labor versus capital gains. So the value of your labor is essentially assessed as more tax-worthy than the value of passive income. Now, this system obviously benefits the rich, who are able to spend more of their money on investments and are able to collect more passive income than an employee or a worker who has to sell their labor in order to make money, and then that money can be taxed, right? And oftentimes, by the way, the money coming out of that employee-employer relationship or client-contractor relationship is much, much lower than the amount of money coming out of passive income. So the system obviously benefits the rich. And the rich in the United States are almost entirely the capitalist class. Very few people in the middle class ever get rich. And if they do, the amount of rich that they get is so minuscule compared to that of the capitalist class that it they're effectively with the rest of us as labor workers. So this is obviously unfair to the workers, and it presents an opportunity where we can change the tax code and collect a lot more money from those people who are not working for a living. Now look, if they're working for a living, then that income will be assessed at labor rates, and their passive income will be assessed at capital gains rates, and that's fine, whatever. But in order to, and I talked last week about funding the IRS is class war. This is another method at which where the workers can fight back against the capitalist class and have real bring real democratization to the economy, which is to tax passive income rates much higher than they are now, and at least as high and preferably higher than labor income tax rates. Because we should be encouraging people to work instead of invest, and not because there's anything particularly great about work, but if people are going to sell their labor, they're going to sell their time. We should honor that sacrifice by taking less of that money than for people who are not doing anything and just enjoying the high life and just allowing their investments to pay them and for them to continue to stay rich that way. So in order to continue in order to reverse the class war that's been perpetuated on the working class of this country, as well as funding the IRS, like I talked about last week, one of the ways that we can fundamentally change the tax burdens in this country and thus create real redistribution is by taxing the rich and passive income much more than we tax labor income, which will allow for more money to come from the rich and less money to come from the poor. And thus, by using that to bolster social programs or just to diminish the amount of inequality in the country, we bring back, we make our system, our economic system, and our political system by proxy more democratic in general, which is an inherently good thing for socialists, but also for the working class and the working people as a whole.